All right. So we're in chapter 22. So y'all have questions about 22. Okay. Um, chapter 22 overall is about budgeting. These are the different budgets, but I guess the main thing is gonna be starting with the production budget, just going over that. And so this is a reminder of what the production budget looks like. Um, we identifying all of the sales that we have for each of the period of times. Then we're looking at what's the desired ending. So we add those two together and then we subtract the desired beginning finished goods inventory. So both are finished goods. And we look at the end result is we trying to calculate the total production units. So I'm pulling up some stuff on the side, but this one is about, I guess, memorizing or remembering those intricacies, like figuring out how to calculate the finished goods, figuring out how to calculate the ending and the beginning, and so on and so forth. Gonna pull up a question from a different book. Um, let's see. So I'm gonna use a different book I could find. Let's collapse. Okay. Because I think I gave other questions from the same book, and it's not a lot of questions on that. So I'm trying to find a budget question. Sales budget, quarterly production budget. Okay. So this is another example of a production budget question. Here. So I could go through this particular question. Wording would be very similar to what you should see on the exam. Because they tend to be okay. But this question says, turn a company produces and sells automobile batteries and heavy duty HD 240. The 2017 sales forecast is as follows. So this is for the quarter. This is what they expect to sell for the quarter. They have to give you the sales information in order for you to figure out the production information. The January 1st, 2017 inventory of HD 240 is 2,000 units. So in other words, January 1st, 2017, if you're doing a 2017 information, that means that's the beginning finished goods inventory, 2,000 units. The production budget is always in units, not dollars. And so we have 2,000 units. Management desires the ending inventory each quarter equal to 40% of the next quarter sales. Sales in the first quarter of 2018 are expected to be 25% higher than sales in the same quarter in 2017. Prepare a quarterly production budget. So, like I like to tell all my accounting classes, accounting as comprehension. This is the wording is different, but it's what you're used to already. It's about comprehension. And so if I open up a blank Excel on my screen and I'll split it. Okay. So I open up a blank Excel. I'll work it out in Excel and set it up and everything. And so this is the E23-4. I'm gonna set it up with my different quarters. So my quarters, and I have 1, 2, 3, 4, and then so prepare quarterly budget. Okay, and then the total. So a total. So I'm gonna put the columns based on what information I'm trying to share. If this was for 1 month or 1 quarter, then I only needed the one. But because they said I'm doing it for each quarter and in total, I have 5 columns show that information. All right. Like I said, be reminded that this is in units. So they didn't give me sales dollars, but if they gave me sales dollars, I'm ignoring the dollars. I'm only looking for units. Okay. Production budget is based on units. So it starts with the sales. Oops. Oh, gee, happening? Budgeted sales in units. And so they say we have 5,000. So 5,000, we have 7,000, we have 8,000, we have 10,000. Thus expected sales in units, that what I'm expecting to sell. Like I said, from the sales in units, we normally have to plus ending inventory, and you could leave a space. I won't penalize if you don't have anything there, but then we less beginning inventory. And that usually give us units of production. So the amount of units that they need to produce in order to do what they're trying to do. And so, like it says here, we read, and the hardest part is going to be these inventory, understanding what is supposed to go there. In the question, they told us January 1st, they had 2,000 units. So that's my beginning inventory for the first quarter. The first quarter starts with January. That's the beginning of the year. So 2,000 units is my beginning inventory for the first quarter. In order to figure out my ending inventory, I have to look at what they tell me. They say management desires an ending inventory each quarter that's equal to 40% of the next quarter's sales. So therefore, that means if I wanted to calculate the ending inventory for the first quarter, it's going to be 40% of the second quarter sales. Second quarter sales is 7,000. So 7,000 times 0.4, 40%, 2,800. And so that's going to be my ending inventory at the end of the first quarter. And so I take that plus the 5,000, gives me 7,800. 7,800. That's a calculation, so I could put a line there. And then another calculation, 7,800 minus 2,000, that's 5,800. And so in this case, 5,800 is going to be the amount that they need to produce in the first quarter. So I'm going to ask that you could attempt the second one. I'll give you like 2 seconds to attempt the rest. And then I'll come in with it. Let's put my lines. If you don't have the double lines in this, it's okay. It's not terrible, but I should be able to see the lines and let me know this and this, how I get that. And this plus this gives me that or whatever. So it should be clear as to where it comes from. All right, so moving on to quarter two. Beginning inventory for quarter two is always going to be the same thing as ending inventory for quarter one. So therefore, I'm expecting that to be 2,800 as well. And then when I look at my ending inventory for quarter two, again, 40% of next quarter sale. Next quarter sale is 8,000 units. So 8,000 units times 40%, that's 3,200. 3,200 units is what I put there. So 7,000 plus 3,200, 10,200. And then 10,200 minus, minus 2,800 is 7,400. And then we just keep going. So beginning is the same thing as ending here. So 3,200 is what I put here. I'm looking at the next quarter's sales, 10,000. 40% of 10,000 is 4,000. So that's 4,000. 8 plus 4 is 12,000. 12,000 minus 3,200 is 8,800. And so that is the production for that particular quarter. Going on to quarter four, same concept. If I ended with 4, I'm starting the new quarter with 4. So 4,000. And then they told me, because they didn't give me quarter one here, but they did tell me that sales in the first quarter of 2018, which if we're doing 2017, then the next year should be 2018, are expected to be 25% higher than sales in the same quarter in 2017. So that's just saying that they didn't outright tell me the sales, but they gave me the information to figure it out. If they say it's 25% higher than the same quarter in 2017, we're doing quarter four. So quarter four in 2017, no, sorry, we're doing quarter one next. Sorry, quarter one sales time. So 5,000 times 25% means 1,250 higher. So that plus 5,000 means that it's 6,250 are the sales that they are expecting in the first quarter of 2018, which is what we need to figure out the ending inventory here. So the ending inventory of this quarter, the last quarter of 2017, should be the same amount there. So 6,250, 6,250 times 0.4, 40% means that ending inventory, they want it to be 2,500. So 2,500 is my ending. When I add that up, 12,500. When I subtract it, 12,500 minus 4,000 gives me 8,500. And so that represents quarter four. Your total column, again, we have to think about it before we use it. When it comes to the sales, you could add that across. That's 30,000. And when it comes down to this ending inventory, the entire quarter represents a whole year. So my total represents a whole year. The end of the last quarter is my ending inventory for the entire year. So I'm going to take the same 2,500 from there, and that's applicable there. If I added 32,500, my beginning inventory is going to be what's at the beginning of the year. So the beginning of the year is all the way over here, 2,000. And so therefore, 30,500 would be my total units that need to be produced. So in other words, I want to sell a total of 30,000 units, but I need to have more, that plus extra to pretty much to sell it, because I don't want to run out of inventory. 1 second, Eliana, I see you. Add that ending, subtract the beginning, and you get 30,500. Go ahead, Eliana.
Can you re-explain how you got the answers for quarter four again, please?
Sure. So quarter four, the sales part, they gave us 10,000. The ending, the ending inventory is going to be based on the next quarter, the following quarter. The quarter following is only 4 quarters in 1 year. So the next quarter is going to be the first quarter of the new year. That's why they told us sales in the first quarter of 2018. So that's the new year, because we're working on 2017 numbers. 2018 is the new year. Are expected to be 25% higher than sales in the same quarter in 2017. The quarter we're trying to figure out is quarter one, 2018. They say it's 25% higher than the same quarter in 2017. So I need to know quarter one, 2017 in order to figure out quarter one, 2018. Quarter one, 2017, like we had there, the sales were 5,000. Y'all want me to wait, or y'all want me to just, okay. 5,000 is in quarter one of 2017. It's 25% higher. So I'm going to take 5,000 times 25%, meaning that it's going to be an extra 1,250 expected to be the sales for quarter one, 2018. So the sales for quarter one, 2018 are going to be 5,000 plus 1,250 $6,250. That's my sales for Q1 2018. I need that because that's the next quarter after Q4. And so 40% of that is expected to be my ending inventory for Q4. 6,250 times 0.4 is 2,500. And that's where I got that from. Jada and Michael, those y'all want to ask your question now?
No, we figured out. They explained it back to me.
Okay.
Yeah.
Okay. So 2,500, we're adding it to the budgeted sales, 12,500 minus beginning inventory. Our beginning inventory came from our ending for Q3, 4,000. And when we take 12,500 from 4,000, we get 8,500. Any other questions? So y'all get it? Don't get it? Questions?
No, I got it. Any questions I have, other questions is like for a different chapter, and that's like in the chat already.
Okay. Oh, some stuff in the chat, my bad. Okay. So that's, I know 22, we going over the problems. So the next one, let's see if I can find a question in here from the cash budget. So that's a production budget. Should be a cash budget now. Let me see. This one too easy. No, pick that one. Too easy. Okay, so the next budget in this chapter is the cash budget that y'all need to know. With the cash budget, we're just paying attention to how payments are being received and how payments are being made. And so we could
Miss
do this
Brennan,
question. Sure. Hey, sorry.
what page was the one we just did? What page was that on?
This is from a different book.
Oh,
Y'all
okay.
want me to send that?
But you were recording this anyway, so I could go back.
Okay, I'll take a picture too and put it in the chat. Either way. So 1 second. Okay. Okay, so just put it in the chat, the picture. Probably could do a picture of the final answer as well. Mm. All right. So going down to the cash budget next. Come on, come on. What was that question? Okay. I think it was this question here. Okay, so we can go off of this question here. You take a picture of that one time. Oh, never mind. I'm gonna do this one instead. This one is a lot more. Let me do this one instead. It's a full one, so it should be fine. Okay, so this one here, Korean Landscaping Inc. is preparing its budget for the first quarter of 2017. The next step in the budgeting process is to prepare the cash receipt schedule and cash payment schedule. To that end, the following information has been collected. Clients usually pay 60% of their fee in the month the service is provided, 30% the month after, and 10% the second month after receiving the service. Actual sales revenue for 2016 and expected for 2017 are as follows. give us that information. So they have to tell us how much revenue is expected, and then they have to tell us how that revenue is going to be split. It could be between cash, it could be between credit sales, but the question tells us. So is no the same way every time. The setup is the same every time, but the way it's calculated can be different every time. It depends on the question. So it says purchases of landscaping supplies, direct materials are paid 60% in the month of purchase and 40% following. Um, Actual purchase of 2016 and expected purchase of 2017 are as follows. We're going to prepare the following schedules for each month in the first quarter of 2017 and for the quarter in total. And then determine the following. Well, I'll leave B off, but I'll just do the top parts. Okay. So let's pull it on the side. Oh, gee. Okay. Sorry. It's not working with me today. My mouse is not working with me today. All right. So E23-18 is the cash budget. Make it a little bit bigger. Okay. And so in terms of the setup, we're starting off by identifying the months. So we could leave a column just for information or the writing or whatever, but then you need the columns based on whatever months you're working with. And so they say that it is for the first quarter of 2017. So that's going to be January, February, March, and then they say on the total. So we put a total. Okay. Those are your main things. And so then I start off with my cash receipts. And then I have my cash payments after the fact. And so my cash receipts are going to be based on how we expect to receive our revenue. Either we expect to receive it in cash, in full, or credit it first and then receive it as later. And so we have to go based off of what they tell us, which is, well, so clients usually pay 60% of their fee in the month that service is performed, 30% the month after, 10% the second month after. They always give you more information than you need or just extra months that aren't the ones that you document, and because you need to figure it out, some of it is going to fall in certain place. So what I would say is start with the first one. They give you November 2016. Okay, so they give you November 2016. If they give me November 2016, then that means, if I think about it, that means in the month of, I'm trying to figure out how to write it for y'all, I guess. Let me start with January. I'll start with January. January sales. How are January sales going to be? January sales are 100,000. Until they say 60% is going to be in the month of service. So if it's sales in January, that means we had to provide the service in January as well. So that means 60% of this has to be done in January. 60% of 100,000 is in January. 60% of 100,000 is $60,000. So let me put it in dollars, commas. So 60% is there. Then that means 30% is the month after. The month after January is February. So 30% of the January numbers, which is 30,000, is going to be in February. And then 10% of 100,000 is going to be in March. That is overall $10,000. So when we add it up, because they told us 60, 30, and 10, that's 100%. These three should come back to the same 100,000. It should come back. Okay. February sales, they said for 2017 is 120,000. 60% of that 120,000 should be collected in the same month, so should be collected in February. I'm not collecting anything for February and January, so that should be 0. February is 120 times 60, that's 72. Is it? I know. 6 times 12. Okay, right. 72. So $72,000, 60% of February's numbers is going to be collected in February. Then I look at March. Oh, sorry. March is the second month. So therefore, 30% of this 120 is going to be collected in March. 30 times 12 is 36. So that means 36,000 is going to be collected in March. Okay. I don't need to go any further because I only doing it for January, February, and March. I don't have to. If it confuses you and you need to, by all means do it. But if you don't have to do it, don't do it. Because I only looking for January, February, and March information. And then it saves time if you're only doing what you need to do. Okay. And then if I go to March, March is 140,000. So March sales, 140,000. I'm not collecting anything for March and January, not collecting anything for March and February. So I'm collecting 60% in the same month. So 60% of March is going to be collected in March. 6 times 14, I ain't that good, is 84. So that means 84,000 should be collected in March from March sales. So that's these three. Okay. I'm not finished because technically if I go backwards now, so I'm using the same month, if I go backwards, they give me December numbers, which is 90,000. Why they gave me December numbers is because 60% will be collected in December, the same month. 30% of December is going to be collected in January. And then 10% of December is going to be collected in February. So December, January, February. So I could document the December sales here as well too. 90,000 is the amount. 90,000 times 30%. 9 times 3. I can't think about that either. 2,700. So 27,000 of December is going to be collected in January. And then there's the 10% of December is going to be collected in February. 10% of 9,000 is 90,000 is 9,000. And by March, everything is paid off. So technically, I don't need to collect anything in March. Okay. Then November sales, they gave me November as well. They told me November is 80,000. Why? 60% of November is collected in November. 30% of November is going to be collected in the month after, that's December. And the second month after November is January. So we're going to be collecting 10% of this 80,000 in January. 10% of 80,000 is 8,000. And so therefore we expect to get 8,000. As a hint, right? Usually if there's 3 different percentages, you're going to find that every month is going to have 3. That's a hint. So because yes, 3 levels that's going to be collected. So I'm going to add that up. The sum of the 3 here is 95. The sum of March and February, 111, 130. And then the total is just going to be the sum that's across. So 60 plus 30 plus 10, that's 100. Then we have 108. Then we have 84. Then we have 27, then 36, then we have 8. So in total, their expectation is that they're going to collect $336,000 for the quarter. They didn't say anything about cash sales or credit sales. They just say clients pay 60% now, 30 next month, and 10% month after. So I don't have to separate any cash sales. But if they did say there were cash sales, then cash sales are usually collected in the same month. So let me see if they have one here. Okay, they may not, so I didn't go that far. But if it says that, then that means that's what's going to happen. Let me see the example in the textbook. Okay. So for example, so estimated cash collections. Cash collections show that 40% of billed premiums are collected in the month in which they are billed, 50% paid in the first month, 6%, and then 4% late. Okay, we did that one. We practiced that one. Then here, that's purchases. Trying to see. Okay, so this one here is an example where they're talking about cash collections. So they said sales for October and November are 80,000 and 60,000 respectively. Cash collections on sales are 30% in the month of sale, 68 in the month after the sale, 2% of the sales are uncollectible. There's another wording that you could probably look at. If something is uncollectible, that means we're not going to collect it. So therefore, when we're calculating our payment, or the receipts, we don't need to include the 2% because it's not being collected. The whole purpose of this particular part is to document how much cash we think we're going to receive. And if something is uncollectible, that means we're not expecting to receive it. Okay. Just looking for other wording that could come from this section.
Excuse me, sorry, Miss Brennan.
Hmm?
Question. For the cash budget question we just did for E2318, would no, not all. Will we? A lot of lot of those questions will have like a percentage we have to decipher from, or will it be different?
They're gonna have a percentage. That means they're gonna be wording differently, but if you look through the textbook for these type of questions, all of them give you percentages. So you have to
Okay.
work with the percentage they give you.
Okay. Okay.
Yeah.
Okay. And this is the setup like
Yeah.
on your screen. Okay. Thank you.
Yeah. That's the usual setup. This is another example of a cash collection question where they say, they tell you sales on account and sales in cash. What that means is that these amounts are collected right away in the same month versus the on account are the stuff that we sell on credit that we apply the percentages to. So the percentages usually apply to sales on account versus cash is usually 100% in the same month. So I just wanted to make sure I point that out again. So, you see the different types of wording that you can see for that particular part. All right. But that would be my cash receipts part. I would total it up and find total cash receipts. Then the next part I'm going to move into is cash payments. And so with the cash payments, they're going to do something similar. They're going to tell me how we're paying off our particular bills and what bills we paying off. Some bills we pay it every month based on what it is. We don't wait to pay it. Some we pay a certain way. And so they have to explain that to you. So here they say purchases of landscaping supplies, which are direct material, are paid 60% and 40%. And then they tell us what the actual purchases are. So it's the same concept. January, February, March. I'm going to start with them. January, February, March. And so they say 60% in the month of the purchase, 40% in the following month. In January, I purchased 12,000. So 60% of that 12,000, I'm going to pay for in the same month, January. So 60% of 12 is 72. What? Oh, yeah, 72. So 77,200 of January is going to be paid for on January. That's 60%. Then the 40% of January, so the difference is going to be paid in February. So minus 12, 120, 48. So 4,800 is going to be collected or paid in February for this January purchase. There's only two percentages, so it's only two at a time. In February, 15,000. 60% of 15,000, so 15 times 0.6, 9. So nothing is going to be paid for in advance. So 9,000 of February is going to be paid in February. And then 6,000, the difference between 15 and 9 is what's going to be paid in March. Then for March, purchases 18,000. 18,000 times 0.6, 10,800 is going to be paid in March. Again, I don't have to show April, so I'm not going into April. I'm stopping there. Okay. Go back to the other ones. If I go to December, if I charge 14,000 and I paid 60% in the month, so 60% in December, so 40% of December is going to be paid in January. So that's 14 times 0.4, 5,600 of December is going to be paid in the month of January. And when I look at, oh, that's all they give me. So that's all I need really. Because I have 2 for every column. Just like I said above, if you have 3 categories, then you expect to have 3 numbers. I have 2 categories here, 60 and 40. So I only expect 2 numbers each. And so I put in my total cash receipts here and I sum it up in this instance. I'm just dragging everything over. And so I'm finding the total, that's 12,000. The total here, that's 15,000. Total here, 10,800. Total here, 5,600. And my total receipts, total cash payments are as follows. Okay. That's 12. Just making sure that's right. Okay. Yeah, because that's a lot of cash collected, but not a lot of cash receipts. So, and so this is the cash receipts part. This is the cash payments part. What I'm going to do is I'm going to say that we only need to do the 60 and 40 based on what they tell us to do it on. So in this question, they said direct materials, but they didn't give us anything extra. But if they gave us anything extra, that's 60 and 40% aren't, we don't use that for those things. We only use the percentages for what they tell us to use the percentages for underneath the cash payments. So for example, let me go to the other textbook. So here they would have told us inventory purchases will total 40,000 in May in this particular question and 30,000 in June. The company pays for half of its inventory in the month of purchase and for the other half the month after purchase. That's where we apply in half and half, so 50% and 50%. Here, they just say that the company will pay, oh, this is your homework, I think it was. The company will pay 5,000 in cash in June. So in June, we take out 5,000 in cash related to office furniture. Sales commission budgeted at 3,000. So that means we expect to pay $3,000 in June for sales commission. So there's no calculating 50-50 on these, only 50-50 on these amounts here, because that's where the 50-50 is applied. General expenses budgeted for June are 20,000. Depreciation represents 1,000. So of course, we know we have to take depreciation out of this 20,000. And then that's the expenses for the month of June. They didn't say we paid some now, some later. So we are to assume that we paying the entire thing in the month of June. Okay. Then there's a minimum balance, etc. So this would only be finished if it had anything else. And let me just add some stuff in so I could show a full working out of it. Because the cash payment section, I'm going to add these extra stuff in here. And so I'm going to add where they said general expenses are budgeted for 20,000. I would say general expenses and I would put 19,000 because 20 minus 1, that's 19,000. So every month, I would say we spend 19,000. If I'm doing for 3 periods, then that same 19,000 I probably expect to pay every other month too. Then they say they purchased office furniture in June. So let's say June is actually February. You could put purchase office furniture, and that 5,000 would go in the month when they actually made the purchase. And we spent 5,000, so that's how much cash payments is going to be made. We only putting in what cash is being paid here. We put up here what cash is being received. Okay. Let's say I got a loan. So maybe the company got a loan of $100,000 in the month of March. Then, oh, sorry, getting a loan is receipt. Sorry. They paid off a loan of $10,000. Then you would say loan repayment. You just document what happened. And then 10,000 spent on that loan repayment. In the end, we get the total for all of our cash receipts. Our cash payments at this particular point. And then we have to get our net increase or decrease in cash. And that is going to be, sorry, let me take this off. Yeah. So that's going to be equal to the cash receipts minus the cash payment. So this minus this would give you what my net increase or decrease in cash is. When it's positive, it's an increase. When it's negative, it's a decrease. Okay. And then we take our beginning cash balance. So let's say we keep it like here. Cash balance for June 1st is 13,000. I'm going to put 13,000 there. That is my beginning cash balance. Just wanted to start there. And so I calculate my ending cash balance now based on my net increase or decrease plus my beginning cash balance. So 76,200 would be my ending cash balance. And so if my ending is the ending for January, for February, that's the beginning as well. So 76,200. And then I total that up as well. I get a new balance 149 versus that 149 is the beginning of March. 149,400, the beginning of March. And when I add that in there, that gives me my ending balance for March, and that is what it is. The total column, if I had to do a total, I'm just going to do the sum of the three. 1, 2, 3. And then I'm going to say my beginning cash balance is this. So similar to the production budget, the beginning of the quarter is actually January. So I'm starting off at 13,000. And when I add the 2, I should come back to the same 233,600. So this would be completing it in full. Yes, Eliana.
Okay, so the general. Okay, I thought the general expenses, purchase office furniture and loan payment. That is from the same question. I thought that was from the a different question.
No, this from a different question.
Oh,
I just
okay.
did it for the purpose of showing you other things because this question that I was using didn't have anything else, and I wanted to do a full example.
Oh, okay. Understood.
So everything highlighted in green is added from another question,
Okay, thank you.
but it's just an example of how you would document it.
But we have to do like this, how you have everything highlighted in green. But we have to do that part for the on the final exam.
Yeah, that's why I wanted to add it in there. So you will have to do a full one.
Miss Vernon.
So just like your homework, because y'all had this same question here for homework, E10A, which is like 1 month of a full one of that. That's what you're going to have in the exam, a full one to do for 1 month. Yes, somebody had a question?
So you say that if we take out a loan, that would be in cash receipts, right?
Yeah, if I take out a loan, it would be in cash
So
receipts, yeah.
like, how would you do that?
Usually the loan part, you add it to the bottom here. So, let's say borrowed $20,000 or something like borrowed funds, sorry. Oops. You would put it as an addition to the cash amount on the bottom because it doesn't decrease cash, it increases cash. So, you would just put that in there as $20,000 received, which would increase the cash balance to 96,000 instead of the 76 that it was in. So you don't necessarily have to put it up here, but if you do, it's not wrong. Usually they add in the cash borrowed funds at the bottom because when they're preparing the cash budget, they only realize they need to borrow funds after they do this. So this piece is already complete. So that's why it's usually slipped in at the bottom. Um, any other questions on this? On the homework for chapter 21, questions 13, 16, 10, and 11. Okay, so I can go to 21 next. No other questions on this? That's good. 22, that's the two problem questions you need for 22. Problem questions carry most of the points, so you don't want to lose out on those, but then you also need to make sure you're reading. Otherwise. Okay. Since you have now just 22. I go to 21 next from chapter 21. That is CVP analysis. Okay. And so what I pointed out you needed to know from this is the high-low method, the contribution margin income statement, and calculating break even. Okay, I want to do a question that I didn't give you all already. So I could do this question. It's a long question, but it's fine. So we're looking at, so the chapter 21, and this is P6, rather long. So it says officials of the, oh, 1 second, let me plug in my laptop. Okay, so officials of the Oak Brook Hills Golf and Tennis Club are in the process of preparing a budget for the year ended December 31st. They have difficulty with two expenses. The processes are delayed. The two items are mixed, electricity and repairs and maintenance. And the treasurer has been having trouble breaking them down into fixed and variable. And so we have to use a high and low method to compute the variable cost rates used last year for each expense. What is a monthly fixed cost for electricity and for repairs and maintenance? All right. So when we use the high-low method, we have to look at each item individually. So I'll look at electricity first. Electricity. When I look at the electricity, I'm identifying the one with the highest cost and amount versus the one with the lowest. So high, low. The highest looks like it's April. So April looks like the highest for electricity. And then the lowest for electricity looks like it is July, which is crazy. But anyway, so that's my high, that's my low. Identify my high and my low. And then I have to subtract the two. So my high in terms of dollars and then in terms of kilowatt hours. So my high in terms of dollars is 268,400. Sorry. And then the kilowatt hours is 8,960. Dollars, my lows are 188,800. My high 6,970. I'm going to take the difference between the two. So the high minus the low. The difference between the two will get me these amounts here. Okay. What I do from this point is I then divide the two. So divide them. So I take the cost divided by the cost driver. So based on this, it's $40 per kilowatt hours. This represents the variable cost. Okay, so that's my variable cost. Now I need to figure out how to get my fixed costs. And so to get my fixed costs, I have to use the cost formula and just plug in what I know and work backwards. Select the highest and plug it in. So I have to plug into the cost formula, which the cost formula is usually the total cost is equal to my variable cost plus my fixed cost. I don't know my fixed costs. So in order to find my fixed costs, I'm going to plug in what I know using the high. And so I'm going to say my fixed cost, so fixed cost is equal to 268,400 equals to my variable cost, 40 per kilowatt hours, and I have the number of kilowatt hours. So 40 times the kilowatt hours for high, oops, sorry, 8,960. And then I add, I don't know my fixed cost, that's my missing information. So from there, I could take out my calculator. 40 times 8,960 is 358,400. So if I was to write it out, 358,400. That means in order to find my fixed cost, I need to carry this over to the next side. So fixed cost is going to be equal to the 268,400 minus the 358,400. Oh, well, other way around, sorry. Other way around. Fix it. Really? Okay, so my fixed cost would be equal to that. So my fixed cost is equal to 358,400 minus 268,400. My fixed cost is $90,000. So that's supposed to be my fixed cost. So at the end, the main idea is you putting together a formula based on the same formula here. And so my formula, my formula is going to be my total cost equals to variable cost. I calculated to be 40 per kilowatt hours. So 40x, x is how much kilowatt hours, plus 90,000, which is my fixed cost. So in terms of what was the monthly fixed cost for electricity, the monthly fixed cost for electricity is $90,000. That's how we work that out. Okay. And so that's just an example of how to calculate using a high-low method. So let's say, suppose we had 10,000 kilowatt hours, then I could use the formula to estimate what my total cost would be. And so I would say, well, my total cost in that case would be 40 times the 10,000 kilowatt hours plus 90,000 means that I expect my total cost to be 490,000 based on the formula that I put together. And so that's what the high-low method is. That's how it works. That's how that one, we would do that. Okay. Any questions on that? Okay. So that's that particular question. That's your high-low method. Then what I'll do is go through the break-even analysis. So a break-even analysis question, we have to, I'm going to do this P7. We have to figure out usually break-even units in sales dollars, break-even units in units, and then sometimes they ask us other questions or target income. Let me see if I find a question. This is how I need targeted income. Anyway, I'll add it to the end of it. Okay, so P7 is what I'm looking at here. And so it says, at the beginning of each year, LED Lighting Limited's accounting department must find the point at which projected sales revenue will equal total budgeted variable costs. The company produces low voltage outdoor lighting systems. Each system sells for an average of $435. That tells me that's my selling price. Variable costs per unit are $210. That is my variable cost, and fixed cost is $166,500. That's all you need to know to figure out break even. You need to know the selling price, variable cost, and the total fixed cost. All right. And compute the break even point in sales dollars. If I want to compute it in sales units, sorry, the break even formula, which I would have told y'all, formula is fixed costs divided by contribution margin. That's the break even formula. And you should remember, you should remember as well, in order to find contribution margin, the contribution margin formula is your selling price minus your variable costs. Okay, so to find the break even in sales units, and this is the break even formula in units, sorry. To find it in units, I'm going to take my fixed cost. So for question 1, my fixed cost, which is $166,500, and I'm going to divide that by my contribution margin, which is selling price minus variable cost. Selling price is $435. Variable cost is $210. So $210, $225. So if I take this divided by 225, my break even in units is going to be 740 units. So in other words, I need to sell 740 units if I want to earn a profit of 0. Break even is the profit of 0. And so that would be how much units I need to sell to make $0. 2, if I had to calculate that in sales dollars, I'm taking the same 740 units. I have to take my units times the selling price. That's the only way to get my break-even point in sales dollars. So let me just be specific. Break-even units times selling price. Break-even units is 740. So I'm going to take 740 times my selling price, which they told me is $435. So that just means I have to make revenue in dollars of $321,900 in order to break even. So for break even questions, the main idea is you have to remember the formulas. Okay? Without the formulas, you're going to get it wrong if you're not sure, or if you remember from math class how to do this, because this is in one of the math classes, then that may be okay. I just need to see that you know how to calculate what you're calculating. So you could use a math way, or you could use my formulas. all right, which come from accounts. So they like to give you these, and then they like to say, okay, find the new break-even point in sales units if the fixed cost goes up by 10,500. So they like to give you an alternative. If my fixed cost change, what's the new break-even? Well, we use the same formula, which is why I say you need to know the formula. We would take but the fixed cost is just more now. So 166,500 plus the additional 10,125 means fixed cost is now 176,625. Contribution margin stayed the same. It's still 225. And so when I divide the two, I get 785 units. All right. And so, I mean, that makes sense because when you have more costs, that means you need to sell more in order to make a better profit. So usually when you add more costs, the unit to break even tends to go up. Okay. Usually when you decrease costs, it goes down. If you increase the selling price, then you need to sell less to make the same amount. So it usually goes down as well too. And then I'll do an example so I make this one up. So green, if I want to make a target profit of $30,000, what are the number of units I have to sell? That's my additional question that I'm adding, just because you will get something like this in the exam. And so to answer that question, it's a similar formula. So I'll copy this down, but this is going to be target units. So the target units formula is going to be fixed costs plus the targeted income. Oops. And divided by the contribution margin. So that's the only thing that changes. So if I want to find the targeted units, I'm going to take fixed costs. Let's say we keep it at the same 166,500. So fixed cost is 166,500 plus my targeted income of 30,000 divided by that same contribution margin of 225. That's going to give me, I need to sell about 873.3 units. Now, if your answer has rounding, they usually tell you where to round it to. So pay attention to that as well. But always round at the end. But at the end of the day, if I wanted to find my target units, this is going to be how I figure out the target units. Same formula. It's just that I'm adding the targeted income to my fixed costs. Any questions? I'm extending it so I could take a picture of it. You. Okay. The only other thing I would say from the chapter problem question wise, no, you're not saying anything, so that's fine, is the contribution margin statement. Trying to find a question. Okay, so let's say I have to rewrite this entire, let's say I have to rewrite this entire income statement here as a contribution margin statement. A contribution margin statement just says that I'm going to separate my stuff into revenue less variable costs equals contribution margin. and then less fixed costs equals the operating income. Okay. And so based on what's here, if I was to take this approach, my contribution margin, it should come up with the same operating income or loss. It's just that it's organized different. That's the only difference. So in this case, what is this? This is question E15A. So just do that like that. E15A. It's the same statement I would put. So the name of the company, America's Company. And did they tell me for this year? I guess I'll put December 31st, 2026, 2025, whatever. That'll be my heading of my income statement. So just like a regular income statement has a heading, I'd include my heading, my revenue or sales, which is the same thing. It's $225,000. Right? Then I have to show my variable costs. In this case, they had a number of different ones. I'll list them. Since they listed them, I'll list them as well. All your variable costs goes after revenue. And so they usually give you all of this information and tell you what's variable, what's fixed. You just have to put all of the variable costs together, and all of the fixed costs together. So my variable costs, 60,000, 30,000, 45,000. And for clarity, I'll pull this over here. My total variable cost equals to these three, the total of these three. I take the 225 minus the 135. My contribution margin is $90,000. And then I'm going to put my fixed costs in there as well too. So I have fixed overhead costs. I have selling costs that are fixed. I have administrative costs that are fixed. Those are the only fixed costs. Oops. Only fixed costs that I have. One second. So my total fixed cost is next. Fixed overhead was 75,000. Selling was 24,000. Administrative was 36,000. And so the total cost there was 135,000. And so when I take my contribution margin minus my fixed costs, I should get the same operating loss. So I have a loss of 45 here. I have a loss of 45 here. It's the income statement. So this is where the double underline comes into play. And everywhere that I have a total or I subtracted or added, I usually add the line below it as well. Okay. Now this is in total, but something to point out as well. Okay, sorry. Something to point out as well. With this particular statement, they like you to show it in per unit, and then they like you to show in dollars. So this is the overall dollars, but per unit just refers to the fact that how much is what's the contribution margin for one item. You know that information because in order to get revenue amounts, we have to take the number of items we sell times the selling price. They told us that it's 60,000 units at $3.75. So therefore, that means in order to get that 225, they would have just said 60,000 units times $3.75. Cents. Gave you 225. So the per unit revenue, which is the sales price, is $3.75. Then our variable cost is what you show next. Yes, we have 60, 30, and 40. They don't tell us anything over here, but we should know variable cost is the same thing as variable cost per unit times the number of units that I sold. If my cost is $60,000 and I sold 60,000 units, because my variable cost represents how much units I sold times variable cost, then I simply could say $60,000 divided by 60,000 units means that direct materials cost me $1 per unit. Direct labor total is 30,000. If I take 30,000 divided by the 60,000 units that I sold, direct labor is 50 cents per unit, 0.5, 50 cents. Variable costs, variable overhead is $45,000. So I could take $45,000 divided by 60,000 units sold, means that I paid 75 cents each for variable overhead. In the end, my total variable cost is 75 cents plus, oh gee, sorry, plus 50 cents plus $1, $2.25 is my variable cost, is my total variable cost. Okay. And in the end, my contribution margin is still going to be my revenue per unit, so my selling price, minus my variable cost, $1.50. Okay. So they like you to show both. You get points for both. $3.75 is the revenue per unit, variable cost per unit, $2.25. Contribution margin is $1.50. Usually you don't have to separate for the fixed cost. But if I wanted to calculate it for fixed costs, I would just take the total fixed costs divided by the same 60,000. That would give me my fixed cost per unit. Okay. Any questions on that? I had, oh, trying to find, I don't know where my window is. New window. Oh, it's over here. Okay, it's over here. I wanted to pull up something from this class, the review sheet, because I did add something on there. Yeah. So, okay, good. So this is the contribution margin question, right? Compute the unit contribution margin. That would be this is the unit contribution margin, and then prepare the CVP income statement to show both total and per unit amounts. So all of that you would do in that particular question. But let's say they ask you how many consoles would have to be sold to make a budgeted income of 15,000. That's just like taking the contribution margin, the CVP analysis stuff, taking this is the profit plus the fixed costs divided by the contribution margin. So you will get a contribution margin statement and they'll ask you this question. It's the same thing, or they'll ask you a similar question. It's the same thing as what I did here with the target units or the target income. I put that targeted income plus the fixed cost divided by contribution margin. Because I did my entire statement, I've already shown I could get my contribution margin right from here, $1.50, and I could get my total fixed cost from here as well too. So it's just I need the income that I expect in order to calculate it. Okay. So any questions there? Anything else from this chapter? I don't think there's anything else very significant from this chapter. In terms of problem questions, the only other one is going to be chapter 17. The only other thing is going to be from chapter 17, sorry. The cost of goods manufactured statement. I'll just show y'all what it looks like. Because it's just a matter of putting it in a proper order. And so this is a reminder of what it looks like. Contribution margin statement. Cost of goods manufactured statement, sorry. And so be reminded that you have to know the formulas and you have to know what goes into it. So start off with the name of the company, the name of the statement for whatever the year is. It's documented there. Then we start off with 3 sections. First section is dealing with direct materials up to step 1. So we start by calculating how much direct materials were used, because that tells us how much we put into manufacturing. Manufacturing is creating the product. So direct materials used, we start with our beginning direct material plus our direct materials purchased. That gives us that cost of direct materials available for use. We subtract ending material inventory, and that gives us our cost of direct materials used. So 100 plus 200 is 300, minus 50 is 250. Second section looks at our indirect, or all of the costs that go into work in process. The costs that go into work in process are the direct materials we use, the direct labor, and the overhead. So that same 250 from step 1 plus the direct labor costs of 120,000 plus overhead 60 means my total manufacturing costs, you can get points for remembering these wordings, is $430, $30,000. Okay. Be reminded, direct labor, sometimes they give it to you not as a number. Sometimes they tell you something like, sometimes they tell you something like the staff worked 50 hours and their pay is $30 per hour. So you would have to take the 50 hours times $30 per hour, 1,500. So they don't always give you the total direct labor. Sometimes you have to calculate it. And so you're just looking for where they talk about the workers and how much hours the workers worked and how much we pay them per hour. That lets us know the direct labor costs. Overhead is the same thing as, what's the other word? Indirect costs. So anything that's indirect or is overhead, you put it here as well. If they give you about 5 of them, you're supposed to list all 5, not just total it up. Okay, list all of the accounts, because again, it's hard to see things if we have the total, we need the detail, right? But the total of the cost of goods, cost of direct materials used, total direct labor, and total overhead or indirect costs gives us the total manufacturing cost. The total manufacturing cost is what we use to add to beginning work in process and subtract ending work in process to give us the cost of goods manufactured. And so if you ask for a cost of goods manufactured statement, it's only this piece. This income statement part, we don't need it. Okay, unless it asks us for an income statement. All right, but your cost statement of cost of goods manufactured is this top piece above. We use direct material, beginning and ending balances for inventory, and work in process, beginning and ending inventory balances. We don't need finished goods. So even if they give you finished goods inventory, that goes in the income statement. Okay, it doesn't belong on the cost of goods manufactured. So if they give it to you, ignore it. It doesn't belong. Things like selling and administrative, and like I say, finished goods inventory, beginning and ending, don't belong. So you can simply ignore them unless you're doing an income statement along with your statement of cost of goods manufactured. Okay. And based on my memory, you only have this piece to do. Any questions on that one? Okay, so that's from chapter 17. That's the only thing to focus on from chapter 17, as well as, let's see, as well as if you pay attention to some part of chapter 17, it's up to this part. Once you get up to that part, the rest of it isn't as important. Okay, so you get up to this section. When you start looking at this, I mean, it matters, but it's not, we catch it other places anyway. So it doesn't matter for this class, actually. Sorry. Okay, so that's chapter 17. And then the last part is going to be, so we did 17, we did 21, we did 22. The last one is 25. And so that's your short run. Like I said, not the entire chapter for this as well. We only look at this piece here, learning objective 7. So LO7, where we talk about analyzing capital investments using the different methods. And so the focus is on the capital budgeting methods, NPV, and payback, and the ARR. So these formulas you absolutely need to know. So for, it's not highlighting good, 76. But for the ARR, these two formulas are the ones you need to know. Anyway, whatever. Sorry. These two formulas are what you need to know for ARR. ARR is calculated as a percentage. Know the advantages and disadvantages as well, because they tend to be in multiple choice, I would say. But the accounting rate of return, or ARR, we take the average annual net income divided by average investment costs. And the average investment cost is this. So remember that it's average annual net income, not just your income. So if they give you income information, you have to make sure that if there are any expenses, we have to take it out of there because they said net income and not just income. So you look at the average annual net income divided by the average investment cost. And the investment cost on average is your total investment minus residual value divided by 2 plus the residual value. Once we do all of that, we get 23%. There's no need to use the charts, the tables. Like I said, the tables will be given to you with the rates, but there's no need to use the rates for this method. The rate is only used for the NPV method. So you just, for this ARR, you just have to know the two formulas. For the payback method, there's a formula here. There's two ways to do it based on, of course, if something is the same every time. So if a number is the same every time, or if it's uneven, we treat it differently. So if it's the same every time, we take the cost of the investment divided by the annual net cash inflows. Net cash inflows, meaning we take out any expenses that are not cash related. Okay. And so be reminded that if they talk about depreciation, make sure depreciation is taken out of this annual net cash inflow, because depreciation has nothing to do with cash. So it's not a part of the calculation. And sometimes it's given. Just like it says here, they said, assume the estimates for the proposal include revenue increases of 17, operating cost increases of 11. We know revenue minus expenses gives you net income. But we have to figure out how much depreciation is included in this, because they told us it includes depreciation and taxes, and it should not include depreciation. Sometimes they tell you how much depreciation is. You just subtract it from the 11. Then you take 17 minus whatever the difference was from there. That's your net cash. Now your net cash, net income. Sorry, annual net average net income, something like that. Cash income, no. We subtract that depreciation from there. If you don't know the depreciation, you have to calculate it. Most times they keep it simple and they use the straight line method, which we know is cost minus the residual value divided by the number of years. All right, so this is just the straight line method depreciation that y'all learned in 105. So calculate that and remove it. And then the payback period just equals to the cost of the machine divided by cash revenue and cash expense minus cash expenses. That's the same thing as this. Annual net cash inflow just is cash revenue minus cash expenses. And so that's why we have to take depreciation out, because depreciation is not a cash expense. It's just an expense. Okay. Payback period, answer is always in years. Okay. And if it was an unequal payment, what you do is you look at all of the payments received and you try to find out, okay, how long does it take before we add back to the amount we initially spent. And so that's that one that I would have shown on the board as well too. Okay, and then NPV, final one. The NPV method is the one where we look at the cash that's coming in for a particular investment in the future, and we have to discount it to the present. And so in this example we did in class on the board, we had two instances. One where the cash that's coming in as a result of making the purchase is uneven, and then the cash is even. When it's the same amount of cash I expect to receive every year after I've purchased that thing, then I take that annual amount, multiply it by the factor in the annuity table. So not the sum table, but the annuity table. The annuity factors are usually bigger than the sum of a dollar table because they account for multiple payments. So in this particular case, there was the same $6,000 being received for 5 years for this particular company. And so what they would have done is they would have had to, this is page 1106. They would have said, okay, 6,000, and I need to multiply it by the factor that comes from the table. The table we're using, if I go back, this is page 1106. So I go to the back of the textbook. Like I said, these factors will be given to you. It's the present value table, because there's a present and there's a future value table as well. So this one is present value of dollar, present value of dollar, present value, present value. Okay, so this one only shows the present. It's not showing me the future value table. Oh, okay. So present value, of an annuity, that's multiple payments of the same thing over and over. I'm going to go to that present value of a dollar received every or each period. That's an annuity. The question was 16% and 5 years. So I'm looking for 16%. So on the next page, 16%. And then 5, where 16 and 5 intersect right here, 3.274. Let me make it bigger. So where 5 is the period, and we go over to underneath the 16 column, 3.274. And so they would have used that 3.274 as the factor that they multiply the annual cash amount of 6,000 by to get this present value. Then when we're considering an alternative, always remember that the residual value is a cash receipt as well. It's a cash receipt at the end of how much ever periods it is. And it's not an annuity because it's a one-time payment. And we multiply it by the factor from the table for that. So in this case, it was $2,000 being received as residual. It's a 5-year investment. So that means at year 5 is when I'm going to receive this $2,000. It's still a 16% factor. So 16%, they told us, is probably the minimum rate of return. So that's a percentage that they will give you. They will tell you the years, and they will also tell you the percentage. It's just using it in the right tables. Okay. Because this is a one-time payment, I'm going to go to the table with the annuity of $1 or payment of $1. So this one, present value of $1 received at the end of a given number of time periods or at the end of 5 years. So I'm going to go to the factor for 16%. 16% and 5, so 5 and 16, 0.476 is what I'm going to use. 0.476. So you take the 0.476 times 2,000, gives me 952. The total of the two represents the overall present value. So we determine what the value of $6,000 is for the next 5 years, how much that's worth today. Somebody be willing to pay this amount. And we determine how much is it worth it to spend $2,000 to receive $2,000 in 5 years. It's worth $952. And so the sum of the two is there. That's considered to be the present value of the cash inflows. The method is called the net present value, meaning that we're subtracting something from this present value amount. The amount that we're subtracting is how much we paid to determine what the net present value is. So the net present value is the difference between the present value and the amount that we spent to purchase whatever this is we're trying to value. Once we have a negative number as a net present value, it's always going to be a bad choice. Okay, and we can't just flip it and say, okay, 21 minus 20. No, as long as the present value is greater than the cost, then it's positive. If the present value is less than the cost, then it's negative, which is what happened in this case. Present value, they calculate was 20,000 and it cost 21. So that's why it's a negative 404. In the other example, the present value was 17,803 and they spent 17,505. They spent less than it's worth to them. So therefore, it's a positive difference of 303. This particular question is different just because it's not the same payment every year compared to this one. They receive the same $6,000 every year. But in this one, they don't. You're going to get a question that's more like this one. Okay? What that says is make sure you're using the right table and the right factor. Okay? When you have different payments, so the first period, we receive 6, then we receive 5, 5, then 5, then 4, then 4, then 2. We're going to use the present value of $1 table when we have different tables, different amounts being received. So in year 1, we have to use the 6% factor for year 1. Then we have to use 16%, sorry. For the second payment, we have to use a 16% factor for 2, 16% factor for 3, 16% for 4, 16% for 5. And then the residual value is at the end. The end is 5 years, so it's the same. Usually the last two are the same. All right. And I go to the table, 0.86743, etc. I should be able to find it right here. Underneath 6%, 1, 2, 3, 4, and 5. 6%, 1, 2, 3, 4, and 5. These here, well, these 4 here are the factors that we use in our calculation because we were given a certain amount at the end of every year. We use this particular table and not the annuity table. All right. So any questions? Okay, no questions. Y'all sure no questions?
Yes, ma'am. I think we understand. I think.
Okay. So everybody else good? I think Eliana asked something. Asked something about chapter 21 homework. Oh, the 21 questions. Well, I can't answer that, I guess, right now. But you'll get access to see the questions. Let me see. There was a chart. Let me see the questions. It was 13, 16, 10, and 11. Now, I don't know if these are the same questions, so Campbell Inc. earned sales revenue of 150. Campbell sells each unit of its product for $6 and has a 32% contribution margin. Okay. Campbell has fixed costs of 36,000. What is the break-even point? So it's a contribution margin question. It's a break-even, but you could also do break-even with a contribution margin, which is a percentage. And so what that means is that if I'm selling my unit for $6, so that's what they told me. I'm selling it for $6. That's my selling price. Contribution margin, we should know, is selling price minus variable cost. That means that 32% is the percentage of contribution margin. So let me try to document it so you could see it, hopefully. So my selling price is $6. My variable cost is, I don't know, but my contribution margin is a certain dollar amount. I don't know that, but I do know that it's 32%. That means that the contribution margin is 32% of the selling price. So if it's 6 times 32%, that means $1.92 is what the contribution margin is. The variable cost should be the difference between the two because 6 minus blank gives me 192. So I just need to say 6 minus. Now I'm doing it the other way around. And so if we have, it may not be exactly like these answers, but it should be close. But that means my variable cost is about $4.08. My selling price is 6 and my contribution margin is $1.92. So if I take it, it should come back. If I use the same formula, fixed costs, 150,000 divided by my contribution margin of 1.92, I should come back. I should be very close to something. Ooh, way off. Nope. What is the question? Oh, sorry. Fixed costs. Oh, sorry. Fixed cost is 36,000. I missed that. Still off. 36,000 divided by 1.9. Oh, break even in sales dollars. Okay, see this way. It's important to read. So this is the formula. So the fixed cost divided by contribution margin is the formula for break even units. And the question is asking for it in sales dollars. So it should be that I take the units times the selling price. I should get the answer. Which is, I did 112,500. So this question just use the contribution margin approach, and the contribution margin percentage approach, sorry. The contribution margin percentage just says that if sales is 100%, contribution margin percentage is the difference between sales and variable cost from a percentage point of view. So that's what that's referring to. So it's slightly different from what we've already seen. So that's 10. If I was to talk about 11, same thing, contribution margin approach. I pretty much showed y'all that one, so y'all should be able to figure out that one as well. 13 says Share and Care International is trying to determine how many clients must be served in order to cover its monthly service overhead. Using the high-low method, it has determined that the variable cost per unit is 800 and the monthly fixed overhead is $28,000. Assume an average fee of $1,400 per client and a targeted profit of $26,000. The number of clients to be serviced is. So that question is just like saying the high-low method. So that's just like this formula here. They give you the information for the formula. They left one thing off. In this case, they left off the X because we don't know how much anything is. We don't know. They asking us how many clients. So the clients is the thing that causes the price to go up and down. That's the cost driver. And so with this type of question, there's a similar formula, but they're giving you profit and revenue and stuff. So the formula that I would say to use, because they're not just looking at cost, they're looking at the entire picture. And so the profit is usually equal to sales minus expenses, right? You know that already. Sales minus our expenses, in this case, our variable costs and fixed costs. So you would use this formula, plug in what you know in order to find the number of clients. Okay. And then keep in mind, you could further expand this as well, because you would need to in this case. Profit equals to sales. Sales is calculated by taking the, I guess, number of clients, which I can call X, times the selling price. So selling price times the number of clients minus, oh, I didn't need the thing. I didn't need the bracket. Oh, sorry, no, I'm not supposed to be telling you the complete answer. Selling price times number of clients minus variable costs per unit times the number of clients minus the fixed cost. So that's what that is. That would be how we calculate the profit in this case, is an expansion of this particular thing. Y'all should have learned this in math as well too. So that is that particular question. That one isn't too bad. And then 16, if fixed costs are 18% and contribution margin per unit is 4, the break-even point is that. We went over that as well. Okay, so I hope that answers the question. But all homework definitely due Saturday, Sunday, because I need to get y'all final grades. Be reminded, like I said, I put 50% in the final exam slot just so that you can see what grade you have thus far if you were to get at least a 50%. So in other words, if you get more than 50%, aim for more than 50% anyway. If you get more than that, your grade will be better than what it shows in Moodle right now. After I mark it, I do take out all the 50% and I put in your actual grade so you will be able to see your actual grade as well. All right. But any other questions, comments, concerns? Please make sure you have a calculator. Make sure you have a pencil. You could bring a ruler as well if it helps with neatness. Leave your smart watches and smart glasses and all them smart rings and stuff at home. No calculators that can store information because I will be letting you all clear them before the exam starts. So all of that, be mindful of that, please, and thank you. Bags will be at the back of the room, as usual. So yeah, any questions?
Oh, do we need like a form of ID or no? Or we could just walk in like normal.
You're supposed to have your ID in every exam.
Oh, okay. I was just asking. All right.
Okay.
That's it.
Okay. So if that's it, then you guys are free to go. I will be posting this video as soon as